Welcome everybody. This is the first in our series of webinars around building financial resilience. We aim to be here for about 45 minutes, which will leave some time for Q&A as well. As we say, leave your questions in there. I am pleased to be assisted today by two of my colleagues, experts who will be helping me along the way. And we'll also have a poll in the middle of the webinar as well to get your feedback on some of the challenges that you're facing. So let me start by introducing who we are. So I'm Samantha Wildman. I'm Group Client Director here at MPA. I've been here for about 11 years, and my role is really to help SME business owners on their business journey. So looking at their challenges and what services they need, how we can support directly or how we can support some of our partner network. Prior to that, my background is really been in IT, helping people with issues around cybersecurity, antivirus, firewalls, all those sort of things. So I have a bit of a passion for the IT side of things. So if I'm talking about clients and situations, I tend to have a bit of bias towards there. I'm really pleased to be joined by a couple of our experts, Richard and Gary. Gary, would you like to start and introduce yourself, please?
Thanks, Sam. Yeah, good morning, everyone. My name's Gary Jesson. I'm the Group MD of our predominantly outsourcing part of the MPA Group. So we help SMEs run parts or all aspects of their finance function, whether it's part-time sort of bookkeeping, payroll, all the way through to senior people, fractional CFOs, FDs, which is the terminology at the moment. And organizations like us work with a lot of early stage SMEs through those growing pains, putting resilience into their business and getting them on a journey to fundraising, exit, or wherever the owners want to head. So wealth of experience across many sectors. Actually, great fun working in the SME space.
Excellent. And Richard?
Good morning, everyone. Thanks, Sam. Thanks, Gary. My name is Richard Lupson-Darnell. I am the Corporate Tax Manager here at MPA, having joined last autumn, but I have probably about 30 years experience of advising SMEs from all stages of their business life, from startup all the way through to exit and succession and passing the business on, if that's what happens in families. So my passion is to guide my clients through that tension that there is between paying the right tax rate or as little tax as possible, but also being able to sleep at night. So there's risk involved as well. So that comes into play, and we'll talk about that later.
Excellent. So my role in this really is just to drive the slides and make sure everybody's speaking at the right time, which is the hardest role because these slides never do as they're told. So let's start with the next slide. See, it hasn't moved there. So today we're going to cover a variety of subjects around building financial resilience, and it's a massive topic on its own. And there's going to be lots of different needs and support that you're going to need along your business journey. And today we're covering the key areas here that are on screen. This is really aimed at the start of your journey. It's about building that right foundation, because as you can see on the screen, the top one says how to avoid being the top 60%. Now, the stats say that 60% of startups fail. And mainly this is due to the failure to prepare. So this is going to sort of talk to you about how to prepare, what you need to be aware of, and some of the pitfalls along the way. So, Gary, I mentioned the journey that the businesses go on as they start. Do you want to just give a quick overview of what that journey can look like?
Yeah, no, thanks, Sam. I mean, this slide sort of depicts a fairly sort of typical profile of an early stage company, whether it's tech or across any sector. You often sort of find this early on sort of self-funded stage where people sort of bootstrap, spend the bare minimum, often get money from what we talk about, the three Fs, the friends, families, and fools, that are happy to back you and take that punt early on. But as a business grows, you sort of professionalize, you need more money, and other factors come into play, whether it's grants, whether it's R&D money. And then really after that, it gets a bit more serious, because you really are bringing in some professional investment. And at that stage, you've got to have great systems, you have great models, good team. Otherwise, you're not going to attract that next level of funding and move on. I think what tends to happen is a lot of people sort of kick things down the road to that later stage, but you really need to build that sort of resilience in very early on in the business. Otherwise, you become one of that sort of 60% that never gets past the first couple of columns on this chart.
Great. And obviously you said this was like the ideal situation, but reality?
Yeah, no, this is the reality, and this isn't me demonstrating my artistic skills. This is often what happens to an early stage business. There'll be twists and turns and bumps in the road, and you've got to be resilient and ready to deal with those. An example of a marketing business that I did some work with not so long ago. They were doing about 400 grand a year, and had an opportunity to pitch for £1 million contract with a major blue chip company. The reason they could do it in the end was several, but one would actually, I helped them and got them to have a very conservative dividend policy. So rather than make lots of money, take it out, they left money in the tank and left it in the business. So they wanted to grow, and they recognized they had money to grow. We also negotiated some really good terms with the customer. We got 50% of £1 million build up front. However, they had to spend half of that with an external company to help build some content. And because we had money in the bank, and because we had access to a funding line where we could take that invoice and raise some money against that invoice, they actually won the contract, secured the contract, delivered it on time. Otherwise, they'd have probably been like a lot of companies here, they'd have gone backwards before they went forwards. And the reality of growth is most companies run out of cash when they grow, because they end up paying out before they get money back. And that's why you get this sort of squiggle rather than that nice linear graph. So it's about keeping hold of cash, putting some real financial resilience in to get yourself past that 60% and onto these further parts of the growth curve.
Yeah, and then there's what happens to that 60%.
Yeah, and that's very much the point. Just saying, Sam, that people fall off the cliff at this stage because they put their foot to the floor to grow, but there's nothing in the tank. They stripped all the money out. They've got no cash. They've got no facilities, and invariably, they're spending money ahead of earning it. And we see it there. We talk about some funding there, things like R&D and tax, which we'll pick up as we go through. But again, they're invariably, again, costs that you spend before you get the money back. And that's the problem with growth. You often have to invest ahead of being paid by your customers. And that's why people actually, even with a big sales pipeline, fail at this stage, because they don't have that cash headroom or that resilience to actually be able to grow the business, to get them to that bigger scale.
And one of the things that is really interesting to us is the challenges that businesses are facing. So here's a poll that was done from NatWest clients. So it's 500 business owners that were interviewed and polled, and it sort of reveals that business owners are showing a healthy appetite for growth. 2/3 of British business owners surveyed reported that they were looking to grow their business by focusing on areas including product diversity, can't get my teeth in, product diversification, market expansion, and by increasing their digital presence and e-commerce. Some of it also by financial management. 3 in 5 business owners found 2023 to be one of the most challenging in business, and their key challenges were generating new business, rising operational costs, cost reductions, cash flow problems. So we're really interested to understand the type of challenges that you are facing, to give us some real-time update on this information. I'm going to stop sharing. I'm going to put a poll up. Hopefully you see it. If you just take a quick second to answer how things are affecting you, and then we can look at the results, and then we'll carry on with the rest of the information. So stop sharing, bringing up the poll, launch poll. So I can't see the poll. I'm just going to give you a minute to read through those questions and answer. And I think, Gary, if you go in, you can most probably see the results in a minute and give us an overview of what those results are.
So what it's saying, Sam, is that just over half, so 56%, are saying generating new business is one of their biggest challenges. The other challenges coming up, rising operational costs, that's nearly a quarter of the people, and cash flow, about a quarter of the people. So similar sort of profile really to NatWest.
Yeah, that's good. I mean, my background here at MPA is business development and generating. Oh, I can see the results now. And generating new business. So yes, I do understand the challenge. And there's also the challenge from a buyer's perspective of committing to future expenditure when the market or your own market isn't completely secure. So yes, that is a challenge that I'm aware of as well. So being able to be more efficient in what you're doing, getting the most out of what you've currently got as your own assets is most probably ideal. So now hopefully you can all see the slides again. I'm getting used to modern technology. But Gary, where do you start?
It's interesting, isn't it? Yeah, businesses all start at different places, but here is my interpretation of where business should be thinking and flowing, and really a lot of it sort of starts around the business model, because a lot of businesses just don't progress, either because they've got the wrong model or they get too fixated on a particular model that perhaps isn't right. So, an example, I work with a number of tech businesses as well, and particularly software as a service businesses. And I had one that started off it was a marketing product, selling it on a monthly per user model, which is fairly quite typical. But the reality is the customers that they were dealing with wanted more of an annual licensing model. And actually, from a business model perspective and a cash flow perspective, it was absolutely right for them to build 12 months at a time rather than 1 month at a time, because it made a massive impact in terms of how they funded and how they scaled the business. And it's really easy early on to run models where you sort of take on the burden yourself and you don't get revenue and cash in quick enough. And again, that's why a lot of businesses fail. So some real resilience around your model, but flexibility around your model, so you can adapt it to what you're hearing. Because if people don't want to buy on the basis of the model you've set, then you're not going to sell, and therefore you need to listen to the market and adapt things as you go. Once you've got the model right, it's really important about getting your systems and your data right. You learn very, very quickly. You get lots of data nowadays, particularly if you're dealing with the public. You've got to make sure your systems and your processes really help you interpret the thing and make the right decisions, and move forward based on what you're hearing rather than perhaps what you're thinking, because customer sentiment and customer feedback is absolutely important. The revenue model, I've just touched on, a revenue model on day one doesn't have to be the revenue model on day two. Models will evolve. And it's important that you evolve your business with what your customers are saying and what your competitors are doing in the marketplace as well. So, flexibility, absolutely key to survival. Cost flexibility, again, a really important point here is that don't sign long-term contracts, don't tie yourselves into big leases, don't hire full-time people if you need part-time people. Doing a piece of work with a business where they making vehicles actually, and they stocked up way ahead of their production capability, and spent a huge amount of money and cash ahead of what they needed, probably 12 months ahead of where they needed to be, which put huge cash flow pressures on the business. I often see companies hiring sort of salespeople way too early because they haven't got a product to sell. But maybe you need a few hours or a few days a month of a salesperson to help you, get the sales proposition right, but you don't need a full time. There's a lot of that type of flexibility now, for particularly professional services, that you can buy on an as needed basis, which means you can hold on to your cash for the things that really matter. And then the final piece here, absolutely key. The companies that survive and thrive are on top of their cash flow. You need a business that generates cash as you go. You don't want to be tying up customers paying you, 60, 90 days, because that's not helpful. Most businesses end up having staff or contractors that they have to pay monthly. So if you're not generating cash monthly, the business will fail. So getting those really early stage stuff is absolutely fundamental. Otherwise, you won't be there at the end, and waiting until 12 months time isn't the right answer. It's about buying things and doing things as you go, and building that foundation resilience as you go into a business model.
Yeah, no, I fully understand. And it's about having the right mindset at the right time in the business. So your example of the company in the motor industry and the stocking up of all the goods and all the parts, that's most probably what they were used to when they were working in a more of an established business, and that's what they needed to do to fulfill the orders. But it's having a different mindset and a different look at, how you're spending the money and what you're doing at the beginning based upon where you are in that journey. And hopefully that reads really nicely onto Richard. We look at what they've got to do to build that foundation, and it's very easy for people to get really caught up in the trap of just focusing on the product or the output. But it's really important to start building that foundation of the business as well. So, Richard, from your point of view, what should you be looking at?
Okay, well, there's 6 areas we've highlighted here. And I started off by talking about tension, and I think tension comes into this all the way through. There's a backdrop. There's always the wanting to make things as tax efficient as possible at the start, but then you have to bear in mind what may happen down the line, and also what might seem tax efficient might not always be. When you stand back and look at the bigger picture of not only your own tax position as a business owner, but also the business. So you have to look at everything in the round. In terms of structure, you typically going to start off with thinking about, am I in this on my own, or am I going to have my wife as a shareholder? That could be tax efficient, or my husband, or family members. Or what stage do I include employees? Do I have a key worker who I want to incentivize, or a team that I want to incentivize? And I think the key here is not to give away too much too soon. I've seen too many people give away and include people at an early stage. The best analogy I have here is when my kids went to university. They spend the first term and a half getting to know friends who they think are friends, and then they spend the rest of the first year trying to get to not hang out with them. And it's only after a period of time that they learn who they could run this whole thing with and who the best people were. So you need to have that. You need to know who actually is going to be there for not only the start, but is going to endure through the process and the lifetime of the business. And that leads on into how do you reward yourself as well. It's a classic situation out there where you think, well, okay, we'll pay ourselves up to the personal allowance, and then we'll take dividends for the rest, and then we spread ownership over a number of people, and that can make things tax efficient, particularly if it's a family. This is where you have to stand back and look at the whole thing and around. Say, for example, you are very, very interested in, and what your business is based on is innovation and preparing new technology, and therefore you're into the R&D tax credit regime. Quite simply, dividends don't qualify for the R&D tax credit, so salaries do. So if you're involved personally and those around you involved actually in the doing of the R&D, it's far more efficient overall, taking the whole thing together, to pay yourself a salary than it is to pay yourself a mixture of small salary and hopefully large dividends. So also going on as you go forward, although potential investors in your business down the line on that graph, particularly as they get more and more professional, will understand what a startup goes through and understand the whole process of paying a small salary, large dividend. They will have all been there themselves. There is a credibility around salary and paying yourself what might be perceived, and it's all perception at that stage, might be perceived as properly. Okay. In all of this, it's very easy to go wrong, and you don't want to save up things for a future that you might have to unwind for the sake of short-term gain. So taking some expert advice for those people who are involved in advising startups in specific areas is worthwhile. Okay, it's a cost worth paying. They may be a little bit more expensive, maybe not, than a general accountant, but as my father-in-law used to say, you can't afford to buy cheap sometimes. So I'd just like to throw that in, that the conversation needs to be had early. Yeah, include your advisor in your strategic thinking. Okay, rather than after the event, oh, we did this, what's the impact of that? Or you're saving yourself up a shock for when you're doing your year-end accounts, or your personal tax returns that go along with it. In terms of fundraising, the government have a number of schemes, but the most common and most well known are SEIS and EIS, and being aware of the rules will stand you in good stead. So arm yourself with some of the basics. So SEIS, you can raise £250,000 through that scheme. The scheme provides tax breaks entirely for your shareholders, potential subscribers, not for the company. The benefit for you is attracting the investment. Okay, so £250,000 for SEIS. They get a 50% income tax break for that. So one classic way would be to say, oh, somebody's come along and wants to offer you £100,000, which they want to do anyway, and you're able to say, well, we're an SEIS qualifying company, pay me £200,000 because it will cost you the same, effectively. As you go on, EIS comes into play. Okay, and that's something that you can apply for in the first 7 years, unless you're a particularly knowledge intensive company, in which case it's 10 years. So these are all things that we advise clients on day in, day out. The headline really is it's very, very easy to go wrong. It's very easy to go. For example, your subscribers need to subscribe for shares in cash. Okay, you can't get loans from them and then turn that loan into share capital. That doesn't work. Okay, and there are many pitfalls along the way. Sam mentioned diversifying as well. So your activity may qualify for EIS or SEIS. Not every company does qualify. Take accountants and solicitors, for example. We're not allowed to have EIS. But if you're diversifying, you need to keep having those conversations with your advisor, because what qualified you in the first place may not qualify in the future. It's a 3-year deal for every investment. to maintain the qualification. Having said that, it's incredibly valuable, so you need to be aware of it. Other tax advantages, clearly, well, the main ones is R&D, and making sure that if you do qualify, that your systems are robust, your reporting is robust. Unfortunately, HMRC are taking a very strong line on R&D at the moment in terms of their inquiring into claims. We would probably argue a slightly heavy-handed, maybe not even slightly, approach at the moment, but we're there to guide you through how to successfully navigate that. And that comes on to how we minimize tax risks. That is a risk. You might have a completely valid R&D claim, but if you don't present it in the right way and robustly, then HMRC could just dismiss the claim. Harsh, but it's what we're experiencing. Okay, so our role as tax advisors is very, very much to get you to that point where you're paying what I would describe as the lowest right amount of tax for your situation. Taking advantage, there's enough in the system, there is enough in the system to achieve that and get a good result. But also there's the risks involved. So the job is to get you to that lowest point without crossing that threshold that will bring sleepless nights, because you're trying something which HMRC are going to come and look at over quite a long period of time, typically.
Excellent. Thank you, Richard. And I suppose for a lot of people, talking about tax and thinking about tax, you just think, I'll do that at another point. It's not important now. But, just to summarise the journey that you sort of took there, you was talking to people, get the right people on the bus, get the right people on the journey. Don't just fill the seats. Make sure that you are set up correctly, that you are rewarding and incentivising people in the right way, and being able to make yourself attractive to people who want to invest in you at an early stage without giving away too much equity of your business, and then setting the right foundations down to then allow you to grow in a scalable way that you don't have to go back and unpick everything and then to make it work. So you make it sound very, very simple, and I'm sure it is. But with anything, Richard, or Gary, actually, there is pitfalls along the way. It'd be really good if you can take us through some of those common mistakes and pitfalls that people make and maybe how to avoid them.
Yeah, no, thanks, Sam. And particularly relevant to some of the points that Richard raised. The first point here around equity retention. I find owners and founders usually very precious about retaining 100% of the business. I've seen other options as well, but I always sort of try and get them around the mindset. 100% of a cupcake is not as valuable, perhaps sometimes, as 25% of a big Victoria sponge. You've got to look at that big picture if that's where you're trying to get to. And most people find a smaller percentage of a bigger beast is hugely more valuable down the track. But the flip side of that is also, don't give away too much. I mean, Richard touched on it, but I worked with a business a while back where he bootstrapped the business. So every time he took on lawyers, accountants, technicians, he swapped services for equity. So it'd sort of get a piece of work and give them 1% of the business. When he got round to a serious sort of first raise, he'd already given away 45% of the business by way of sort of bartering services for equity. Made it really hard for him then on that first round to actually get a sensible valuation and actually retain a sensible amount of equity to keep himself interested in the business. It's really easy to give away equity, but you've probably given it away way too cheap if you're bartering services early days. So to really think that one through and get that advice. Things like owner remuneration, Richard touched on it. You are the R&D brains of a business. If you don't pay yourself, you're not going to maximise your R&D claim. So it's really important to get that right, so that you maximise that tax advantage. Bootstrapping, again, see it a lot. Often a way into a business growth, but sometimes people just bootstrap for way too long. And you miss the real opportunity that's in front of you. Competitors come and go and overtake you. So somewhere along the line, you need to get out of that bootstrapping mentality and really put the plan to grow the business, put the resources, as Sam says, get the right people on the bus, raise the money, whatever it is, get it right, and move on fast. Otherwise, the market comes and goes, particularly in the world of digital. Things are just moving so fast nowadays. Slow hiring here. Again, slow hiring, right hiring is really important. And the point, I think, for me here is that, I touched on it earlier, you can get people now on a as you go fractional basis in most professional services. I say to people when they say to me, when do I get an FD? And my argument is, you get an FD on day one. You might only need them for an hour or two a month on day one. And as you grow, you might need them a bit longer. But those models are out there now, and too often, me and a lot of people in my network, we end up digging companies out of holes and problems because they didn't hire the right person at the right time. And that isn't just internal. Richard touched on it with professional advisors. I'm doing a bit of work with a business at the moment that they got their accountant to do an SEIS claim, and it's turned out it's wrong, and it's cost the investor best part of 100 grand in lost tax relief. And again, the market is such nowadays, you don't have to have one person deliver it all. If you're hiring a professional advisor, ask them about their experience in SEIS, EMI, R&D, because invariably they're trying to do the right thing by you, but often do the wrong thing by not bringing in specialists themselves to help you out on your journey. So getting that hiring right across professional services, staffing, contracting, is really important. We've touched on the trading, and obviously the partnering is very much the same thing. There are a bunch of people you can bring in that can help you out, and the successful companies bring those people in at the right time, and don't leave it too late. Lots of things to think about, but also lots and lots of good resource and people out there that can help you on that journey. And keeping them flexible, even on the partner, in Richard's point, if you don't really know whether they're going to be the right for you in 12 months' time, then partner with them in such a way that you haven't given them equity. You cannot exit them quite quickly if you want to, because what they're good for now might not be good for you in 12 months' time. So keep that flexibility with what you do.
Excellent. That was really, really useful. I don't know if anybody's got any questions. If so, if you want to put them in the little dialogue box, as I say, it's a speech mark with the questions in. The chat box doesn't necessarily always come through, but while people are thinking of questions to put down, I do have a couple from people that had asked already, and I think one for both of you. I'll start with Richard first. I mean, you talk about SEIS, EIS, and the benefit of it. How do you go about getting that status? Just as a high level, what's involved?
Okay, right. So helpfully, HMRC provide a process called advance assurance. Okay, so you have to provide them with a whole list of information. Typically, your business plan, answer a load of questions around what you're trying to achieve. Also, key, and probably is a gateway to entry, is them understanding or being assured that your investors are have their capital at risk. They could just lose all of their money. If there's any basis in which they're assured that the investor knows that they're not going to lose any of their money, then the chances are you're not going to qualify. So anyway, HMRC offer that advanced assurance process. It's something that we do on a regular basis for our clients. And then they give you this piece of paper, it's a letter saying, yes, we thanks for your application, here's your advanced assurance, which means you can then go shopping. for investors, because it is incredibly valuable to be able to go to potential investors and say, by the way, we're already pre-approved by HMRC for SEIS or EIS or both. Okay. So after that, you raise your money. Everybody's clamoring to get involved, and 4 months after that, typically can be quicker for SEIS. Then you apply again to HMRC and say, look, we've done what we said we were going to do, and then they provide you with certificates which you pass on to your shareholders, your investors, and that's what they want to be able to claim the tax relief on their tax returns. So it's a very clear, defined process with stages, and can take probably at least 6 months to go from start to finish. Can be longer.
Sam, I think the other interesting pitfall on that, you've got to be clear. You want the money, but actually, what else do you want that investor for? People that go for SES, in my experience, are either professional investors or say professional people with high bonuses, high earnings that want to shelter tax. And they can be a real nuisance because they can interfere with your business. So the money may be good, but they might bring other problems. So as well as getting the assurance side, what Richard talks about, it's actually understanding the individuals involved as well, and making sure they match your business as well. Otherwise, it creates problems down the track.
Absolutely. There's this due diligence thing which you'll come across if you get into selling a business where somebody's running the rule over you. Actually, you need to reverse that process and run the rule over the people that are getting involved with you.
Yeah, again, it's the right people on the bus, isn't it? And I think, Gary, that sort of leads me to you. We talk about having the right people on the bus at the right time, but obviously as that journey goes, those requirements change. So if I'm outsourcing some of those services, you advise to have, an FD type person there at the beginning to help steer people in the right direction, knowing when they should be going for EIS funding or taking advantage of grants or equity investment. As you go along, can you change that person as your needs change?
Yeah, no, absolutely, Sam. And that's the benefit of a sort of contractual type relationship compared to an employee. If you hire an FD, invariably early on, you don't have a full-time job, and an FD might help you get some things straight and systems right. But as the business grows, they may have no experience of, say, fundraising, or you expand geographically and they know nothing about international expansion. It's really hard to sort of exit sometimes an employee. Whereas contractually, if you work with individuals, it's often a notice period. But also, if you work with groups of individuals, so in our group we have 60 FDs across UK and Ireland. It could be just switching out one FD or switching in another one, with some orderly handover. It might be the same with, we sit quite often with the financial reporting part of it. We'll often put payroll people, bookkeepers, and financial controllers in to get all the nuts and bolts ready. As a business grows, the volume increases. We often find we'll back away and encourage the company to hire a full-time financial controller, because it's often a very key hire in the business. So I think it is about giving yourself the flexibility, Sam, but also it's a bit like Richard's point about, you raise money EIS and then you do something different and you disqualify yourself. It's much the same with people. Your people on day one on the bus aren't necessarily the right people, in 2 years' time. And so get them off the bus and put new people on it. Absolutely.
Excellent. I've had one question come through on the chat here. Somebody wasn't able to join. It is recorded, and we will be sending it out after it's all been processed and updated, and then we'll send it out. But I had another question through another means. Richard, we talk about bootstrapping at the beginning, and obviously you're relying on friends and family. When that investment gets to a certain stage, can those friends and family be part of your EIS investment? Or is it only businesses?
And this is one of the details. So generally the headline is no. Okay, but there is a classic situation, and this is where the rules have so many nuances, where actually if you had, there's a limit. You can't have as an investor more than 30% of the company. So the classic is if you had four brothers or siblings that wanted to set up in business, then they could all qualify for EIS or SEIS because they got less than 25%, and the tax system says they're not connected for this purpose. That's an anomaly for siblings. Okay, it doesn't work with kids, parents, uncles, husband and wife. It doesn't work. So the headline is no. And also, it's very hard to convert situations into then qualifying for EIS and SEIS, which is why the early conversation is so important.
Yeah. But if I was your friend and you'd set up a business and I had some spare money that I wanted to invest, but I wasn't part of a company or anything else, could I invest in you and then use that status against my own personal tax?
Yes, you could.
Good. Don't set up a business because I don't have any money to
I'll say I
invest.
look forward to it.
Excellent. So we are coming to the end of the time and there wasn't any more questions. So I've just got a couple of really quick slides. I mentioned at the beginning that this is a series. The next series is really looking at how you can go out and get some undiluted funding. So looking at grants, how grants can work for you and how they can work within your business setup, how they work with R&D tax credits, what you need to think about for maximizing the success of your grant application and the benefits they have. So that's coming up next month, the 7th of March. I'm really pleased to have Dr. Chloe Sharp, who's the head of the MPA Grant Services, to join me on that and take you through that. If you've got any questions that you want answering about your own specific requirements there, please send them through to me. My contact details are there. It's very easy, samantha.wildman@mpa.co.uk. And I'll pass it on to the relevant people, either somebody, Gary or somebody in his team, or Richard or somebody in his team. But yes, thank you all for joining. I hope you found it useful. I think it's a really important thing to understand what you need to be thinking about when, most probably your mind is just in product launch, getting a buyer, getting suppliers, all those things, where actually it is so important to start at that foundation side of things as well. So thank you very much. Enjoy your Thursday. Hope people sort of in the Peak District, an area that up there aren't having any snow, and hopefully you can all join us and register on for our 7th of March webinar as well. Gary, Richard, thank you. I think it's very useful, very informative, and speak to you all soon.